Hey everyone, thank you so much for tuning in. I'm Loretta Carfrush, a realtor with Keller Williams Realty. I recently took a continuing education course and I found the information super helpful not only to myself as a realtor but for consumers as well. It actually seems like most people don't know that much about credit, and this is very important in the real estate world as credit plays a big factor in the qualification for buying a home. Sometimes customers and clients are confused or shocked when they first talk to a mortgage lender. So if you are considering making any large purchases in the near future, or you just want to learn more, stay tuned as I'll be giving you a little bit more information and some valuable information that I learned. Thank you again. Hey everyone, thank you so much for joining me. So what is credit? Credit shows lenders how trustworthy you are when it comes to money. So you may have heard of credit obviously when you were younger, or probably when you first started using money to buy things or you got a job. But it helps them see how trustworthy you are when it comes to money, specifically with borrowing money, because keep in mind, if you're going to buy a house or a car, most people don't have $30,000, $100,000, $250,000 cash to buy a house. So this will show lenders that you are trustworthy enough to borrow that money in hopes that you will pay it back on time and hopefully in full. And you may be wondering, why is credit important? So as a kid, I actually always argued with my dad about how I did not want to use a credit card. I just wanted to pay with cash or my debit card so I didn't have to worry about making payments. And back then I didn't really understand the value of credit in today's world. Luckily with time, I learned why it's important. So again, like I said, most people don't have a large lump sum of cash on hand. And if you do, that's awesome, because then you can just buy things with cash and not have to worry about being in debt or owing anybody anything. But the average consumer does not have that. But that doesn't mean you can't enjoy a car or a house and not just have to live in something that's not suitable for your needs or buy a car that's only $2,000. So if you do want to have those things and live in a place that you actually want to live in, then this actually is very beneficial to have credit and a credit score. So I want to talk a little bit about the difference between a credit score and a consumer report. So these are actually not the same. You may be watching your Credit Karma score for your credit report and think that your number is good enough for a mortgage, but then you may talk to a lender and find out that number is actually different. And it's because they're looking at the FICO credit score, and they can be totally different numbers. And it can be confusing and often misleading to consumers. So it's actually best to talk to a lender, especially in regard to a mortgage, to kind of gauge where you stand. So companies like Credit Karma are using a consumer report, and companies like Equifax and Experian are not used for mortgage lending. So you can kind of use Credit Karma to monitor your score and kind of keep an idea in case you're looking for like fraud and things like that, or identity theft, but it's not going to necessarily help you in regard to a mortgage. So FICO scores, it actually stands for Fair Isaac Corporation, and I actually pulled this from their website, ficoscore.com, and you can see this chart breaks down what your FICO score is made up of. And it could range from 300 to 850, where 300 is on the low end and not a good credit score, and 850 is like the best credit score you can have on their scale. So you can see that it's 35% payment history, 30% amounts owed, 15% credit length of credit history, 10% new credit, and 10% credit mix. And I'm going to talk about the breakdown of all of those in the next few slides so you can kind of see what each of those is made up of. So the largest chunk for your FICO score is your credit history at 35%. Basically, this just means don't pay your bills late. And it's important to focus on these tips because it's going to help build a healthy credit history. So you want to make sure that you're doing things that will build a healthy credit history, because its weight is 35%. So if you're paying bills late all the time, that's greatly going to impact your credit history and show up when they look at your FICO score. So you want to make sure you're paying those on time. Also, it depends on the frequency and severity of your late payments. So if you're doing this often, you're missing payments every month, then that's going to impact you more than if you just missed it 1 month. And then the severity of your late payments. You know, are you 6 months late or are you just 1 month late? So you want to make sure you don't do this frequently and don't make it a severe thing. You can also usually call to ask and have late payments removed once within 12 months. So you may want to try reaching out to your credit company if that is something that you have interest in doing. And the good news is that generally after 7 years, a late payment will remove from your credit history. The second highest category for your FICO score is the revolving debt ratio, which is made up of 30%. So this would be your credit cards and balances. So you want to try and keep balances low with less than 30% of the credit limit on credit cards. 20% would be playing it safe, but definitely don't go over 30% of your credit limit. Pay off credit cards, but don't close them. So a lot of times people want to close those credit cards that they aren't using as much, but you might want to just use it for gas or just for grocery shopping. So some people do that where their credit card is only used for that, and then within a week they pay it off, or by the time it's due, they pay it off in full. And many people think that you need multiple credit cards. So you'll hear of people having like 5 or 6 credit cards, which is insane, especially since you have to keep up with all of that. But in reality, you just need one major credit card, like a Visa bank card or a MasterCard. Try to avoid store-specific cards or department store cards, versus the general major credit cards. And like I said, you can usually get them through your bank. And you may want to look around and see what the different interest rates are. Of course, read the fine print, because usually they'll offer like 0 APR, which is an annual percentage rate. And then the next year it might go up to like 24.99%. So you want to make sure you're definitely paying those balances in full after that 1 year mark, if that's when it is, because 24.99% is massive, especially if you're looking at hundreds of thousands of dollars. You'll be adding on more to your bill. So lastly, pay off your debt instead of moving balances around or doing a balance transfer. So sometimes people will take one balance to move it to another credit card that may have a lower interest rate. Even if it's a little bit lower percentage rate, it's not going to make that much of a difference. So it's better to just go ahead and pay it off instead of moving it around. The next highest segment is length of history, which makes up 15%. Keep in mind, it takes time to build credit history. So if you're just out of high school or college, don't worry. For example, when I graduated with my undergraduate degree, I remember I was going into the car dealership just to lease my new car then. And they mentioned that I didn't have bad credit, but I didn't necessarily have enough credit. And that's only because I had just gotten out of college. So I haven't really had much in regards to credit cards. I did have 2 cards then, but I wasn't using them probably with the advice that I'm giving you guys now. And then also, I wasn't out of school long enough to start paying student loans down significantly. So I still got the car, but keep in mind that can impact your interest rate and everything. So a FICO score is also made up of whatever is reporting in the last 2 years. And these are some of the tips or some of the pointers that the lady gave to us when I took the continuing education course. She said that paying off something outside of the 2-year mark does not necessarily help, and don't touch old stuff. Sometimes it's better not to. The next highest is new credit, which is 10% of your FICO score. And this is about how many new accounts and the type of account. So if you go to different banks or stores to apply for a credit card, that's called an inquiry, within the last 12 months, then that's going to show up that let's say you apply for 6 different cards, then that's going to show up and impact your score. And new for credit, or at least specifically for FICO, was under 24 months, so around 2 years. And then avoid department store cards, like I said before. Try to just stick to a major credit card. And an inquiry is the hardest thing to remove from a credit report. However, it's not going to impact your score, so it'll show up on there. So it might be kind of suspicious if you've applied for 7 credit cards, but it's not going to impact your score that much. However, anything that's on public record, such as a bankruptcy or lien, that will be the next hardest thing to remove. So you also want to avoid those things. As you've heard, bankruptcy usually shows on your record. I think it's around 7 years. And then liens, of course, can impact your house, especially if you're trying to sell it. And lastly, we're talking about the types of credit used, which is also 10% of your FICO score. They just like to see a mixture, so they don't want to just see your credit made up of just credit cards or just a mortgage. They kind of want to see a mixture, and it will help you get a higher FICO score if you're in good standing with multiple accounts. So just keep that in mind. Try to be kind of consistent with all of them all the way around. And unfortunately, renting does not show on a FICO credit score, so that's another reason why it's better to just go ahead and buy a house instead of rent and pay someone else's mortgage. I'm going to talk about a myth about credit that we often hear in the real estate world, and that is inquiries will greatly impact my credit score. So people are often worried to find out their credit score or what their buying power is from a lender because they believe their score is going to tank drastically when they do that. But that doesn't mean go out and apply for every single loan out there, but there's definitely some myths around this. So first I want to talk about the difference between a hard and a soft inquiry, because I'm going to use those terms quite frequently and you'll hear them in the credit world. So a soft inquiry would be something like viewing your own credit or someone else just viewing your credit. It does not impact your FICO score, so that's great. However, hard inquiries are when a lender or a creditor pulls your credit for the purpose of giving you a loan or a credit card. So if you go and apply for a mortgage loan so that you can buy a house, that's going to be a hard inquiry. If you go to open up a credit card with your bank, that's going to be a hard inquiry, because they're not just looking at your score, they're looking at your score and then evaluating it and then giving you a loan, basically, or a credit card, which essentially is a loan too. Now, mortgage, auto, and student loans are actually kind of treated the same. They're bundled together when it comes to inquiries. So it's something that's called rate shopping. And what that means is in that 30-day period, the inquiries will not impact your score if you find a loan for one of those, the auto, mortgage, or student loan. And that's because you may want to go around and check and see if one company may offer you better rates or a better program versus another. So I just suggest that within that time period, you kind of get an idea. Don't take a long time to figure out what you're going to do. Try to get that done within 30 days. And then there's a rolling window, which that can be a little bit different. So FICO scores look on your credit report for rate shopping inquiries older than 30 days. And if your FICO scores find some, then your scores are going to consider inquiries that fall in a typical shopping period as just one inquiry. So if you're looking at FICO scores calculated from older versions of the scoring formula, so they have a specific formula that they use, which I'm not going to explain because that's not my forte, but this shopping period would be a 14-day span. But for FICO scores that are calculated in the newest version of the scoring formula, the shopping period is a 45-day span. So it really just depends on the scoring formula that the lender is using, and you could probably ask them that when you are applying for a loan just to see. But again, as long as you can kind of figure it out, most people do figure out which company they want to go with in regards to a mortgage loan or an auto loan within a 2-week period. So even if it was 14 days, that seems pretty doable. And then also, the last thing is in regard to how many points your score can drop from a hard inquiry. It actually can vary because sometimes people are so concerned like it's going to drop 20 or 30 points. But usually one additional credit inquiry will take less than 5 points off your FICO score, which is nothing. I mean, of course, it can add up if you're doing it consistently over time, but it's easy to get your score back up 5 points with a credit card or with a mortgage at that rate. Another thing that we often hear is, but I already have a mortgage. So just because you have a mortgage, that's not necessarily enough to build your credit. Remember, I said that they like to see a mixture when it comes to the types of accounts. So a mortgage is not enough. You'll need a revolving card, like a major credit card, where the balance may change. And your score could suffer 30% if you do not have a major credit card. So some people may be thinking, you know what, I'm never getting a credit card because I don't want my credit score to ever be impacted by not paying debt or whatever. But it actually shows as a negative on your credit line. So you definitely want to have one major credit card. Use it responsibly, of course. I'm not saying to go out there again and blow it all on shopping and max it out 100%, because that's definitely going to hurt you 100%. But not having one can also drop your score. And again, you need to build credit history so they can see that over time you have done well with borrowing money. And also, don't use a secured credit card unless absolutely necessary. The only time I've really heard of anybody using a secured card is when a lender suggests it, because somebody probably has a hard time managing their finances or whatnot. I don't personally know a bunch about secured cards, but if you are curious about that, you could ask a lender, but usually they don't suggest it. So some credit building tips. Have one open, active major credit card, as I've said multiple times in this slideshow. Use the card at least every 2 to 3 months. So don't just have an empty card sitting there for months and months and months. Use it every 2 to 3 months, gas, grocery shopping, anything like that, and pay it off. Try to keep it at no more than 20% of the credit limit. I mentioned earlier, 30% would be the kind of the limit there. But 20 to 30%, pay your bills on time. That's kind of a given. Plus, it makes it a little less stressful for you. And you can also set up auto pay for a lot of your accounts. So if you just go ahead and set up auto pay for like the minimum balance, then you don't have to worry about checking the date and going in and setting your payment. So you can also reduce the amount you owe. So let's say you have a student loan, or multiple student loans, you have a car note, you have credit cards. You want to try and reduce how much you owe. That's not saying to not use those things, but you need to make sure you don't just have like hundreds of thousands of dollars in debt. So reduce the amount you owe. And then this link has more information if you want to see how you can improve your credit score otherwise. So in regards to home buying, I mentioned some things in relation to home ownership, but don't let your fear of credit hold you back from buying a home. It amazes me the amount of people that are my age or even older that don't even have any credit or have never used a credit card and are just scared. And you won't really grow if you don't actually take the time to learn a little bit more. So hopefully you did learn something from this slideshow and maybe I put you at ease a little bit. But it definitely will help you with home ownership if you can be a responsible credit card user. When it comes to home buying, you definitely want to speak with a lender to see where you stand. I know quite a few lenders that I work with and that I can put you in touch with. There are lenders all over, but I would not suggest big banks, like your SunTrust, your Bank of America. It's just not going to be as good of a relationship. And I also would avoid online lenders, such as like the Quicken Loans, Rocket Mortgage that you might hear commercials on the TV and the radio. You want people that are kind of local to you, that are going to answer your questions, that aren't in another time zone, that will actually help and communicate with your realtor, because I have seen it on the other end where it's a big bank, and I've seen it where it's an online lender and it's not a smooth process, and you want it to be a smooth process. So I can put you in touch with a local lender, or you can research your own local lenders, but please try to avoid those two, like I mentioned. It's also a good idea to start at least 6 months to a year before you plan on moving. So if your lease for your apartment is ending in 2 months and you're trying to buy a home and you're just now talking to a lender, you're already too late unless your credit score is like perfect and you have the amount of money you need saved up and you've been researching on your own. Most people don't do that. So you need to make sure you're prepared. So at least 6 months to a year before you plan on moving, because if there is something that isn't allowing you to buy at the time or at that moment, you want to make sure you have enough time to actually fix those things or those recommendations that the lender's telling you in time to actually move. So if you want to move by next spring, then you need to make sure that you're working on it 6 months prior to make sure that you actually have your finances in order, your credit score is where it needs to be. And like I said, the lender can tell you what you need to do. They may say you need to refinance your car, you need to pay off this credit card, you need to handle this medical debt collection that you have on your report. So they'll tell you what you need to do to help you get to where you need to be, and then you can go back in and say, okay, now I've done these things. Let's see if I now qualify for the mortgage loan. And so that's just a great way to go ahead and see where you stand. And even if it's not 6 months to a year, if you plan on moving in 2 years and you just kind of want to see where you stand, you never know, you may qualify for more than you thought. And it just gives you a good idea of how much buying power you have in the market. Like I said, I am a real estate agent, a realtor for Keller Williams Realty, and my name is Loretta Cartfrush. You can call or text me at the number I have on the screen here. I'm also on Facebook, Loretta Cartfrush-Realtor. You can message me on there as well. And I would love to help. If you're not local, I can speak with you, or I can put you in touch with another agent in your state. And if you are local, I would definitely love to meet with you sometime for coffee or lunch and just kind of discuss some of this stuff, because I'm really passionate about people buying homes, especially young people buying homes. And it seems like as millennials, less of us are buying homes. But I can tell you it's such a good value and an investment, and the rates are still super low right now, and you don't want to miss out on that opportunity. You'll have more buying power in this market than you will if the rates do start to go up. So I highly suggest, if you can get in touch with a lender and you are ready to make that next step, do so. And like I said, you can contact me and I will help you with that. Lastly, I just wanted to talk about, I do donate 10% of my commission to animal rescues and organizations of my client's choice. And so that's every deal that I do, 10% of my commissions earned goes to those rescues and organizations. And that's just because I'm passionate about animals. If you know me personally, you know they're my life. I love animal rescue. I love working with nonprofit organizations. So this is kind of my way of giving back. So if you would like to help contribute, if you work with me, or if you let me refer you to somebody in another state, or maybe if you're further away in Georgia to where I can't help you, I can definitely refer you to somebody, and I will still donate 10%, whether you're a buyer, seller, investor, or a referral. So please let me know if you have any questions about real estate or about this presentation. Again, I appreciate it so much for taking your time to listen, and best wishes.